Imagine this. You walk into a bank with 1 lakh rupees. You hand it over. You walk out. That money feels safe, parked, stored. But here's the uncomfortable truth. That same 1 lakh rupees might already be someone else's home loan, and someone else's car loan, and part of a business loan too, at the same time. No printer, no truck full of cash, just numbers quietly multiplying. And this isn't a scam. This is how the modern money system actually works, right now. Because almost all the money you use today wasn't printed by the government. It was created by banks, without printing anything. And once you see how, it's hard to unsee. Let's start with why this matters right now. Inflation feels permanent. EMIs feel heavier. Savings feel like they're losing a race they never agreed to run. Every time interest rates change, the news panics, markets react, politicians give speeches, but very few people explain the machine underneath all of this, the machine that decides how much money exists in the first place. So let's slow it down, strip the jargon, and walk through it like a story, a very quiet story. You deposit money in a bank. The bank doesn't lock it in a vault and guard it like treasure. That's the movie version. In reality, the bank keeps only a small part aside, just enough for daily withdrawals. The rest, it gets lent out. Let's say the bank keeps 10%. You deposit 1 lakh. 10,000 stays. 90,000 leaves the building as a loan. Now here's where the magic, or the problem, starts. That 90,000 doesn't disappear. It lands in someone else's bank account, which becomes another deposit. That bank keeps 10%, lends the rest. 81,000 becomes a new loan, which becomes a new deposit, which becomes another loan, round after round. Nothing physical is created, but balances keep growing. One original deposit quietly supports multiple loans. This is called credit creation, but forget the name, look at the effect. The system just created new spending power out of thin air. Not fake money, real money. Money that can buy houses, pay salaries, move markets. And it all started with a simple deposit and a few keyboard entries. This is where usually people say, okay, but there must be a limit. There is, sort of. Banks are constrained by rules, reserve requirements, capital ratios, risk checks. But those limits stretch when times are good. When the economy is optimistic, banks lend more. Credit expands. Money grows. When fear hits, banks pull back. Credit contracts. Money shrinks. The money supply doesn't just sit there. It breathes, and banks control the lungs. Here's the uncomfortable math. If most money is created as debt, then for money to exist, someone has to owe. Every rupee created through lending arrives with interest attached, but the interest itself isn't created at the same time, which means, system-wide, there is always more debt than money. Someone, somewhere, has to struggle. Defaults aren't bugs, they're features of the design. This is where the hype and reality part ways. We're told banks lend out savings. Sounds responsible, almost boring. In reality, banks create new money when they approve loans. The borrower's account is credited instantly. No waiting for someone else's deposit, no pile of cash moving around. Just trust, rules, and accounting. This power is enormous. Banks decide which ideas get funded, which businesses grow, which neighborhoods boom. Two identical people, same skills, same ideas. One gets credit, one doesn't. Their lives diverge, not because of effort, but because of access to freshly created money. There's a quiet irony here. Banks are often described as intermediaries, middlemen, but in practice, they're manufacturers of money itself. And when too much money is created too fast, prices rise, assets inflate, bubbles form. When credit slows, the opposite happens. Jobs vanish, businesses collapse.
The same system that fuels growth also sharpens crashes. Zoom out even further. Central banks don't directly control money the way people think. They influence banks through interest rates, through signals, through pressure. They set the temperature. Banks decide how much water flows. This is why interest rates feel blunt, why inflation is stubborn, why financial crises keep repeating with different names. The system rewards expansion and punishes hesitation, and all of it depends on confidence. Because the moment people stop trusting banks, the math stops working. Deposits rush out, loans freeze, and suddenly money that existed yesterday feels imaginary. So here's the question worth sitting with. If most money is created by private institutions through debt, driven by incentives that reward growth over stability, who is this system really designed for? And what happens when it finally meets a limit it can't bend around anymore?